Sticking in the Eurozone, my next guest says European equities are gaining strength against U.S. stocks. Joining me to check the charts is Katie Stockton. She's the founder of Fairlead Strategies and a CNBC contributor. As somewhat of a skeptic of this in the long run, Katie, I love this take. And many people have said you can hunt for value in Europe, especially with the big corporates. Granola was Tim Seymour's acronym for that. But you're kind of talking more broadly.
Well, they have. I mean, listen, European equities have been a source of long-term underperformance versus U.S. equities, and that's been no different over the past year and a half or so. But since February, very quietly, we have seen some outperformance unfold, and it's been gradual. But if you take any of the benchmarks, the stock 600, or an ETF like VGK relative to the SPX, you'll see that the trend appears to have shifted. Some of those ratios are getting above their downtrending 200-day moving averages, and that's more meaningful than the relief rallies for Europe that we've seen in the past in relative terms. So both markets are in cyclical bull trends, so that's good news too. They have positive long-term momentum, but we think that at least this could be the start of inline performance over the coming year or so, if not slight outperformance to continue for European equities.
All right, that's interesting. And like you said, somewhat reassuring that both European and U.S. stocks appear to be in an uptrend as far as you can see it. Let's talk about bond yields, which might underpin the way we think about this. What do you see going on in the 10-year charts? Just as we were breaking higher, now it looks like we're breaking back down.
We've been in the belief that 10-year yields are in a corrective phase within the context of a secular uptrend. And that corrective phase could last even a year, maybe even 2 years, having started last October with the peak around 5%. Just recently, we had a short-term breakdown in yield terms that was mirrored by ETFs like TLT, a very popular treasury bond ETF, or AGG, another U.S. bond ETF. So we're actually interested in taking advantage of this short-term shift here. We're looking for perhaps a bounce in yields tomorrow on the back of the jobs data, which could be an opportunity to add to U.S. fixed income exposure to take advantage of the rising prices as yields come in a little bit. We don't think it will be dramatic, though, more of a sideways to lower trend as effectively the gains in yields are digested going way back to that 2020 low.
That's interesting and kind of tells people, okay, maybe you can look at owning bonds and stocks again, as we did through sort of the whole 2010s and do okay. But your point now is that it might just be a year or two that we could be in this zone somewhat lower for yields. So let's kind of move on from the big picture discussion then. Since you're here, I have to ask about NVIDIA. Without talking about the market cap implications, what do you think about the stock move, broadly speaking, right now and where it might be headed next?
Yeah, I mean, it's really just been a beast. It's got such good, strong upside momentum, and there is no loss of momentum at this time. So that's good news for those that hold NVIDIA, except there is some risk, of course, right? The initial support for NVIDIA is around 974. That's based on former resistance. There's been a series of gaps on the chart that could be closed, and they could be closed fairly quickly as well based on the nature of these gaps, which sometimes are exhaustive in trend. We also, for NVIDIA, have some signs of upside exhaustion or trend exhaustion from the DeMark indicators, and that goes for on the weekly bar chart and also soon likely on the monthly bar chart. So it just tells us that, listen, NVIDIA is not immune to consolidation. It probably will begin to consolidate here in the very near term. And with that, well, then the market is tested a little bit, right? Because the market has had such narrow but very strong leadership from NVIDIA and the broader semiconductor complex.
So how do you square that then if NVIDIA starts to peter out and that's a headwind for broader stocks, but at the same time you were saying they sort of still appear to be in this long-term uptrend. So how would that play out?
I think it's about reconciling the time frame. So we are short-term looking for a pullback in the equity market, especially those benchmarks that are weighted towards the heavier sort of mega cap names. And yet we're still very bullish long term. Even intermediate term, we've seen a lot of breakouts that suggest in the next 3 to 4 months the market will be higher. So we're not getting too concerned about a pullback, but we do think that one is likely from current levels. And our message to clients has been perhaps be hedged partially, but just wait to add exposure, wait for the market to come to you a little bit.
Interesting. All right, Katie, thanks so much. Appreciate checking in with you.
Of course.
Katie Stockton.